Hey guys, today we're going to be talking about the 3 metrics that you must track in order to create yourself a profitable day trading Forex strategy. If you are someone who has been trying to create yourself a strategy, but you're not really too sure about the small little things that you're missing or the tweaks that you need to make, then you need to watch this video because this video serves as a foundation on helping you identify and make the small tweaks that you need to make by first understanding the metrics that you need to follow. And I hate to break it to you, but some of you out there are trading without tracking any of your metrics. And that's the main reason why you're not profitable. I hate to come off strong, but what we have to realize is that trading is essentially like we're playing chess, not just against one other person, but we're playing chess against millions of other players. It's you against every other trader in the entire world. What we have to realize is that trading is a zero-sum game. What does this mean? This means for every winner, there must also be a loser. So if you lose money on a trade, this means someone out there who is either smarter than you, someone who had a better directional bias, a better trade idea, or someone who's even luckier than you has taken your money. So if we can agree on that, then we must also agree that there are some traders out there who are smarter than you. Some traders out there who have been trading longer than you. Some traders who are taking this a lot more seriously than you, and traders who are tracking their metrics. So if we can agree on that, then the question is, how come we are not tracking our metrics when our competition is? So if you don't track your metrics and they do, who is going to be taking whose money over and over and over again? I'm sure you know the answer to this question. So let's talk about it. And I want to keep things simple for this video. So let's talk about the 3 metrics that you must track at a minimum in order to create yourself a profitable day trading strategy. So the first metric we'll talk about is what we call the win rate. This is the number of winning trades you've had compared to the cumulative total number of trades that you've taken overall. So for example, if for a strategy that you're testing, you've taken 10 trades, but you've won 6 of those 10 trades, that means your win rate is 60%. If you've taken 42 trades and you've won 30 of them, that means your win rate is 71%. If you've taken 50 trades and you won 25 of them, that means your win rate is 50%. You can track your numbers by simply creating like a trading journal, maybe creating like a small little spreadsheet and just kind of doing it manually. Or a lot of brokers actually nowadays allow you to see your metrics within your broker's back office. You kind of log in and you can go to your stats and you'll be able to look at the win rate through that as well. Or alternatively, there are many different softwares and programs you can kind of connect your account to, and then you'll be able to look at your metrics that way as well. A common one a lot of traders use is called MyFXBook. You can just simply link your account to MyFXBook, and it'll automatically track all your numbers for you, and it'll give you your win rate. And this is one of the most common metrics that a lot of traders do track and a lot of traders do know. But the reason I bring this up is simply because there is a massive misconception about this number, especially for brand new traders. In regards to win rate, this number is a little bit misleading. Many traders have a common misconception that they need a win rate of over 50% in order to have a profitable or a winning day trading strategy. That's why a lot of beginner traders aim for a win rate of at least minimum 50% or higher. You can actually have a highly profitable strategy with the win rate that's way below 50%. And the reason is because the win rate isn't the only metric that we need to consider when creating a profitable trading strategy. The win rate only tells half the story. We need to also track another metric to truly understand whether your strategy is profitable or not in the long run. And that metric is what we call the risk to reward ratio. What does this mean? The risk to reward ratio shows you the average reward, or R, that you're making on every single trade that you enter based on your risk percentage. Let me give you an example. So let's say we're looking to enter a trade. Currently, you can see I'm on Euro USD on the daily chart. Let's say I'm looking to enter a buy just right over here, right where the market is right now. If I'm willing to risk, let's just say $1 if I lose the trade, meaning if the trade ends up going against me all the way up until here, I'm willing to lose $1. And in this case, if the trade goes in my favor, based on the ratio of the red area and the ratio of the green area, this means my reward is also going to be $1. So if I get the trade wrong, I'll lose $1. If I get the trade right, I'll make $1. So in this case, the risk to reward ratio is 1 to 1. Risk to reward ratio is 1. So for example, if I'm risking $500 on this trade, if I get it wrong, I lose 500. If I get the trade right, I make 500, 1-to-1 risk to reward ratio. And for those of you who are using the same exact platform as I am called TradingView, link in the description if you want to use it, you'll notice that it automatically calculates this ratio for you. So you'll notice as I drag this around, it's automatically calculating the risk to reward ratio for you on the fly. So for example, if I move it just like this, you'll notice the risk to reward ratio, or in other words, some traders like to call this R, the R becomes 2. Why? It's because the take profit is twice the size of the stop loss. Or in other words, the downside risk is 63 pips and the take profit is 128 pips. So if I drag this up a little bit, you'll notice that the ratio increases as well. So all this is, it's just the ratio, the difference between the length of the stop loss and the difference between the length of the take profit. If the take profit is 3 times bigger than the stop loss, that means you're going to get a risk to reward ratio of 3, or in other words, an R of 3. And you also might have probably noticed the greater the difference between the take profit and the stop loss, the greater the difference that is, the higher the risk to reward ratio becomes. If this is super, super, super small, you'll notice the risk to reward ratio can become extremely large. So for example, in this case, if you're willing to risk $1,000 on this trade for your downside, that means you're going to gain 11 times that. That means your profit would be $11,000. So you're risking $1,000 and you're making potentially $11,000. And I can already picture some of you right now are thinking, oh, wow, so why don't I just tighten my stop loss as tight as possible and then make my take profit super, super, super wide? Who wouldn't want to risk $1,000 to make $11,000 in profit? The problem is, the bigger the difference between the take profit and the stop loss becomes, the lower probability you have hitting take profit and the higher probability you have hitting your stop loss, especially if you're a brand new trader. This takes months and months of practice. You need to have really good entries, or what we like to call here at Market Makers University, sniper entries that allow our traders to get high risk to reward ratio trades while still maintaining a high win percentage. But if you are a new trader, what I would recommend you start with is start with a 1-to-1 risk to reward ratio, find out what your win percentage is, and then adjust accordingly. And then you can move the needle and adjust your sliders and KPIs from there. That's a good baseline. And you might find out, based on your strategy, the best R for you to aim for on every trade is probably a 1.5 R. And you might keep it at a static 1.5 R for all your trades and never deviate. Some traders do that. Some traders keep all their trades at 1.5 R and slowly grow their account step by step by step by step and never deviate. Other traders might have a strategy where they have a dynamic risk to reward ratio for every trade, maybe because their stop loss and their take profit is based on technicals. So some trades, they might have a 1-to-1 risk to reward ratio based on technicals. Other trades, they might have a 1-to-3 risk to reward ratio. And they might find out over the course of many, many, many trades that their average R, the average risk to reward ratio, is probably 1.6 R. Or maybe their average R is 1.4 R. When it comes to this metric, you want to find out what your average risk to reward ratio ends up being with all trades considered. Now, the third and final metric we'll talk about today is what we call the average profitability per trade. This metric calculates the average profit or loss per trade on average. Basically, this takes all of your trades into consideration and helps you find out of every trade that you enter, how much money will you make or lose on average. And the equation for this, or how you calculate this, is you take your total amount of dollars that you made, or in other words, your profit, and you subtract all of your losses. So your profits minus your losses, and you divide all that out by the number of trades that you've entered. So to give you an example, let's just say in a fiscal year, you made $100,000 and then you lost $50,000. And let's say over the course of the whole year, you took 100 trades in order for this to happen. That means on average, every trade that you enter, you're making around $500. This is including your profits, your losses. Just on average, every trade that you've entered in the past year, you made around $500. Some trades you lost, some trades you made way more than 500, but on average, you made around 500 with all things considered. Now, when you do this calculation for your own trades, I don't want you to see whatever number that you get and say, wow, I'm making X amount of money off of every trade that I entered. So that means I should just enter more trades because I'll know, for example, every trade that I enter, on average, I'm bound to make around $500. So why don't I enter just a lot more trades? I don't want you to think that way. Why? Because this number is showing you the results that you're getting right now with your current frequency, your current strategy, and the current number of trades that you're entering per day or per week. If you decide to change the frequency and you look for a lot more trades, a lot more trading opportunities, and the trading opportunities that you do try to enter, they might not be as clean as these 100, so you might be losing more trades then. And that number will reduce, or that number might even become negative. So whenever you look at this number, don't just get excited and say, oh wow, I just want to enter a lot more trades because I know on every trade that I enter, if it's positive, then I'm making money. That's not the way you should be looking or thinking about this number. This just simply shows you with your current strategy what the results are right now at the moment. That being said, some of you might have noticed that the other two metrics that we talked about, the win rate and the risk to reward ratio, the win rate can be less than 50% and you can still be profitable. Or if you have a completely different strategy, you can have a risk to reward ratio less than 1 and still be profitable if you have a high win rate. So unlike the other two metrics, where you can have a less than 50% win rate or even a smaller than a 1-to-1 risk to reward ratio that you can become profitable with those, with this metric, it must be in the positive. It must be greater than 0. It must be a positive number. This is non-negotiable. You can think of the other two metrics as like sliders that you can kind of just drag back and forth, and you can kind of play around with those two sliders and you can still have a profitable strategy if one of those two metrics are bad. However, this metric, it must be above 0. A strategy with a positive average profitability per trade suggests that on average, your winning trades generate more profits than your losing trades. This is required for a profitable strategy. Now, just to make sure that you guys are fully understanding this last metric here, I'm going to give you a quick little quiz. You can write the answer down in the comment section below. So let's just say you took one trade per trading day in the fiscal year, which means you've taken, let's just say 252 trades, one trade per day. And let's just say in the whole year, you made a profit of $753,455. And let's just say you lost like $211,940. So the question is, what is your average profitability per trade? Write that down in the comment section below. Let's see if you truly understand this. It's pretty straightforward, not too complicated. Just write the answer in the comment section below. I'm sure you'll be able to get it right. So just to kind of recap everything that we talked about so far, the first metric we talked about is what we call the win rate. Remember, the win rate doesn't have to be higher than 50%. It is a slider that is based on the second metric, which is what we call the risk to reward ratio, or what other traders might consider as R. Now, the risk to reward ratio, the wider the difference between the stop loss and the take profit, just know you have a lot higher chance of hitting stop loss and a lot lower chance of hitting take profit. So don't just get bright-eyed or star-eyed and you really want to just have like a big risk to reward ratio. Be conservative at the beginning so you can find out what a good risk to reward ratio is that fits your trading style. And the third metric that we talked about is what we call the average profitability per trade. This allows you to get a good understanding of how much money you can expect to make or lose based on all the trades that you've taken cumulatively overall. And these are just 3 metrics you can start with at least. There are many other metrics that you can track, many different metrics that you can follow. I didn't want to go too deep into this video. This is just like an intro video for you guys. But do at least start tracking your metrics, because as soon as you can start identifying the weak points, that is how you can learn how to adapt and improve your trading strategy. That being said, take care, and I'll catch you guys in the next video.